You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
To the extent that these programs are successful, I do expect gold to go up, and I expect it to go up without having the corresponding increases in their operating costs, like oil, things like that. And that is the 70s, that is the ideal macro environment for a gold mining company when gold is going up and your input costs are not going up to the same extent.
Welcome back to Mining Stock Education. I am your host, Bill Powers. Thank you for tuning in. Feel free to engage the show by emailing me at bill@MiningStockEducation.com. And one recent listener to the show is a fan of my guest today. My guest is Dan Oliver from Myrmikan Capital, and a listener of this show emailed me and said, Bill, Dan's really sharp. You should get Dan on the show to get his thoughts on the economy, finance, and what's going on with gold and everything else in the world. So with that being said, Dan, welcome to Mining Stock Education. It's your first time. As I look at the markets, we saw that steep sell-off in the general equities, but then they kind of came roaring back here, and they're just about 15% off their all-time highs. Help me understand what's going on here. Everybody seems to be sitting at their houses. The economy's not roaring right now, but yet stocks are going up. What's going on here?
Well, the theory that they teach you in business school and elsewhere is that stocks measure the value of companies, and so you got to figure that out. But of course, in this world, what stocks really measure is liquidity from the Fed. And the simple answer is when the Fed dumps whatever the number is, I forget, 2, 3, 4 trillion, depending on how you count, into Wall Street. They're going to have a party, and that's what's happening. And it doesn't matter what the companies are worth. What matters is how much leverage does Wall Street apply to this new money, and where do they direct it? And every trader just wants to get in front of that wave, and that's what's happening. And it's a good point, because now you can go back hundreds of years and find commentators who talk about the fact that fiat money, that the printing press, increases wealth disparity. It causes wealth to concentrate in the few, and it impoverishes the many. And we see that happening over the last 10 years, especially since the bailout. They printed lots of money, and the financial markets, asset holders, did incredibly well. And most of the country, the workers, didn't. And that's why people like Bernie Sanders and Karl Marx himself have such followers, because that money printing actually sucks money out of the working class and hands it to the rich. And so the fact that they have now accelerated this process tremendously because of this whole lockdown business, I think it's not impossible to see expanding bread lines in the heartland and expanding bank balances on Wall Street, which again seems completely it should never happen, because Wall Street is supposed to reflect the real economy, but it doesn't. It reflects money printing by the Fed. It's called the Cotillion effect, right? And the guy who figured this out was Cotillion, who was operating during the first great modern credit bubble, the Mississippi bubble in France of the early 18th century. And he noticed that people closest to the printing press, the emission of funds, got the money first. And that's precisely what's happening in our world today.
In your view, will the Fed continue to act like the almighty over the markets, or will it be revealed as the Wizard of Oz and not so influential in the future here?
Yeah, I mean, I wasn't sure, as I've written many times in my letters, when the next big crunch came, would gold tank or would it soar, right? Because it's a very different setup from the 2008 period when gold was going up in nominal terms. It attracted lots of momentum players who were all levered up, and they all got margin calls they had to sell. It was a very different dynamic. And one reason I was comfortably agnostic was because I figured if gold did tank first, how long would it be before the Fed ran in and said the system? And that's precisely what happened. Gold did tank, and then within days or weeks or hours, I mean, depending on how you measure it, the Fed was there printing money to make sure the world didn't fall apart. The whole DNA of modern central banking, at least in the West, is to prevent another Great Depression, which essentially was a giant banking economy-wide margin call on everybody, and so they will print the money to avoid that, and so the more inflation impulse moves we have, and we could have more, the Fed will keep printing, and that's I think the key insight into policymaking, which is that the way that banks work, as all your listeners I'm sure know, is that someone deposits a dollar of new money, of base money at the bank, and the bank lends out collectively $10. That's the textbook model of fractions of banking. And as we know, they actually lend out more like $20 or $30 from that $1. And so if you go back and demand that dollar back, they get a big problem. And the way the Fed handles that problem is they just print up a new dollar to make sure that the banking system doesn't unwind. And so this process has played out over so many decades that the short position is enormous, right? I mean, if you looked at the monetary base before this crisis started, it was around $3 trillion, and there's around $90 trillion of US dollar denominated debt. And so when you stop the economy, all that debt demands to get repaid all at once. Now, some of it's terms, so not literally all at once, but it's you start having cascading defaults. And so the Fed says, oh my God, the dollar is getting too strong because there's a margin call, and they feel comfortable printing as much money as they have to avoid the margin call because there's no inflation in the sense that the dollar doesn't tank yet because you're in the midst of this short squeeze. And so they print the money to fill in the money of that short squeeze. But of course, the problem is that they don't really think about is that when they've done that process, when they filled up all those fractures of debts with new money, the bank system can do it again. And so they can massively expand the amount of credit. And that was the purpose of locking up all that money at the Fed last time. They've got a much bigger problem, and I think the real crux is someone asked Powell a week or two ago if he was worried about inflation, and he said no. I mean, he literally said no. That's not the concern right now. This is an existential crisis, and we'll worry about that later. So literally, the Fed, although its mandate is to have a stable currency, it simply doesn't care right now. What it cares is making sure that we don't get a total unwind of this $90 trillion debt pyramid, and consequences be what may later. But so that's what's happening.
So then, how that relates to the general equities? Are they going to continue to rise as long as the Fed keeps on injecting cash, or will there be a sell-off this year that some are predicting?
I think both. I mean, I think what will happen is that there'll be sell-offs, and that will convince the Fed to print more, because the Fed's DNA is don't allow prices to start going down, because what happened in the Great Depression and everywhere is that if you get enough downward momentum in equity prices, you can start getting margin calls, and then you got to sell to get the cash to meet your margin call, but that puts prices lower, and the next guy gets a margin call, and so the whole thing unravels. And it's not necessarily equity markets that care about, it's the debt markets, right, which are even more levered up. I mean, the levered loan market is completely insane. The CLO market has all these things in it, and one of the scary things about this crisis is that if you think about junk paper, right, the high yield paper of really bad assets, when those default, it doesn't really matter so much because everyone knows it can default, and so you've got cowboys in there who can afford the hit. What really screws up the system is when a AAA piece of paper defaults, because you create these securitization structures, you create those AAA paper under these models that say, okay, only 10 or 20% can possibly default. So the other 80% are AAA rated. And then you take the AAA paper and you can lever it up 20 times and do it again, right? So if part of that AAA paper blows up, it's not just the loss that you experience on that piece of paper, it's the 20x leverage you've applied to it that's sprinkled throughout the system. And again, when you look at models, economists think, oh, well, maybe a recession is you lose 1% of GDP growth, or depression, you go down 10%. No one has models where airline traffic goes down 80%. I mean, it's just not in the models. Now, again, I don't think it lasts forever, but it doesn't need to. All it has to do is go down long enough and enough to start tripping up the AAA tranches of these bonds. And then the Fed's got a problem, because what they usually do is, as you know, is when they want to boost asset prices, they go buy the assets. So you can go buy this paper, but if the underlying business doesn't have the cash or support it, then the Fed winds up taking the loss, and they try to organize things so they buy stuff that doesn't actually expose them to real losses. I think they may have gone beyond that now, but that's the theory anyway. And so then they've got to start giving money to the actual companies so the companies can make the payments on the loans so that these CLO structures don't blow up. So that's where the Fed is, and which is why I think that we haven't seen the end of this, and that they're going to print a lot more money to keep these very perilous, very steep pyramid of financial debt from falling over.
We'll be right back after this word from our sponsor. Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com. All this money printing is, of course, very bullish for gold and the gold stocks, but do you think that if we get another liquidity crunch and the general equities sell off, that gold and gold stocks could sell off again?
Well, let's distinguish between two things, what the nominal price of gold and the real price of gold. And it is critical to think about the distinction. If you look at gold between 2000 and 2008, it went from a generational low, Brown's bottom of 250 to 1,000, call it more or less, went up 4 times. Oil went up 13 times. And that's why you had this phenomena where gold miners really never got any momentum going, because gold would go up, they'd have more revenues, but then the cost would go faster. And so there was this feeling in the market that gold miners were a bad business because however gold high went, your costs went up more. And that's because it really wasn't gold going up. Gold was going down in real terms against other assets, and that's because gold doesn't like credit. It doesn't, and that period was a huge credit bubble, and gold hates that. Gold likes when credit contracts. So let's look at 2008. Gold hit a record 1,000. It hit a spike low of 700, so 30%. It didn't stay there, but that was a spike low. The market went down 50%. Oil went down 80%. So if you were unlevered as a gold mine, that was actually a great time for you because your costs went down way more than your revenue did. And so you actually had margin expansion on a gold basis. Now, no one thinks of it that way. And to the extent you've got nominal debt, that doesn't help you very much. But that is what happened. And so looking at the QEs, what do the QEs do? And again, when I got in this business in 2008, 9, because of that crisis, I got it completely wrong. I thought, hey, the Fed's printing lots of money. That's going to tank the dollar. The gold will go a lot higher, and it'll be great for gold mining companies. And the answer is no, it wasn't, because what QE did was it gave reserves to the banking system. It was not a helicopter drop of money. It was specifically giving banks reserves. Banks take those reserves, they magnify them by 10, 20x, right? And they lend them principally against people building assets, people building real estate, houses, office buildings, or airplanes, or generators, or all that CapEx stuff, right? And all that heavy CapEx, what it does is you get overcapacity. It actually lowers retail prices in some areas because you have overcapacity. And so as I said, that was a period of credit growth, and gold doesn't like that. And so again, you have this phenomenon where they're printing money and gold is going down or not going up in real terms. Like, what is going on? And that's what was going on, is that it was the Fed creating a credit bubble. I think these QEs are very, very different in that in this QE, the Fed is not giving banks reserves to go lend against new assets that are in creative capacity. They're lending money to companies to make payroll, so they can go buy, so they can eat and pay rent and cover current expenses. And so to me, these QEs are completely different animals. And this QE is going to create huge amounts of consumer inflation because, again, it's designed specifically to get the money to consumers that are paying it. Now, obviously, Wall Street is siphoning off a large part of that, but that's the design. So to the extent that these programs are successful, I do expect gold to go up, and I expect it to go up without having the corresponding increases in their operating costs, like oil, things like that. And that is the 70s. That is the ideal macro environment for a gold mining company when gold's going up and your input costs are not going up, to the same extent.
What's your outlook for the U.S. dollar?
Well, I mean, again, it's tricky to say because the dollar is in the grip of this massive short squeeze, and you can obviously see scenarios where if the Fed doesn't print fast enough, or they get timid, or the numbers get so large that they get a little spooked, that you could have a big short squeeze again, and then that would create falling asset prices. And then what the Fed would do is say, oh my God, that's a signal that we're not printing enough, and they'll run in and print more money. So I don't think the dollar collapses quite yet, because I think there's still a lot of dollar debt out there that needs to be funded, and people need dollars to pay their debt back. If they don't, they lose their assets. So you still have this indigenous demand for the actual paper dollars to pay your debts back. But I do think that once they restart the economy and they've dumped trillions upon trillions of money, of dollars, I should say, into the economy, well, all of a sudden it'll get a lot easier to repay your debts, right? And I think that's when the dollar starts to fall out of bed. But when I say that, when people talk about how's the dollar going to do, they generally mean against other currencies, against the euro, against the yen, against yuan, whatever it might be. And the way I look at it again is that most of those other currencies have dollars as their primary reserve asset. And so the dollar falls out of bed, they will too, because that's what backs them essentially. And is it the case that Europe or China are going to have better indigenous performance of their own loan portfolios inside those countries? And I think the answer has to be no. I mean, if there's a big economic reset, it's hard to imagine China with its export model doing very well. And of course, as we all know, China has the biggest credit bubble the world's ever seen, so that's a disaster. And Europe has other problems, like an aging population, and they've got too much debt also. So I mean, which currency is the worst? I don't have an opinion about that. I don't need to, because I'm in the gold space, and they're all going to devalue against gold at different rates, and I'm not sure which ones will devalue faster, but they all will.
Over the last couple of months, Dan, as you know, with the virus coming out of China, governments reacted, and this has basically been like a self-inflicted wound to our economies. What type of recovery or what non-recovery do you see coming out of this?
I mean, as I say, I think money printing is pretty clear looking at the theory and the historical record that it has the function of taking money away from the working class and giving it to the speculators. And so I expect that to intensify, which means that you'll have this weird divergence of Wall Street doing really well and the rest of the economy doing very badly. The Paycheck Protection Program helps companies with lots of employees. It does not help companies with few employees. So if you're a really small company and all your inventory goes bad because it's food or you lose yours, you can't pay your rent or whatever it might be, I think there's going to be a lot of failure. And what that will do is it will allow the large private equity firms to come in and snap up even larger parts of the economy than they did last time. And so you'll have further centralization of economic power and further hollowing out of the middle class. And I think it's a total disaster. When does it actually blow up? I mean, that's a harder question to answer. But I mean, look, I think it's hard to imagine a 1930s style deflation, banking collapse, depression, when the Fed has already printed trillions of dollars in the Congress too. I mean, the Congress can't print money, but it can spend money that then the Fed has to fund through Treasury bond purchases. So it's almost the same thing. And not only what they've already done, but what they're willing to do is basically unlimited. And so I don't know how you get that. All the textbooks from the Keynes economists said the problem with the 30s is the Fed simply didn't print enough money. Again, that's just in their DNA. And so they've been training for almost a century. And the idea is next time this comes along, you just print as much money as you can. And look, let's be clear about this. It has worked in a sense, right? I mean, 2008 should have been our 1929, and it wasn't because the Fed was willing to print so much money. And so all that did was create a bigger problem, a bigger bubble. And now this is our 1929. But again, can the Fed overcome that by printing trillions of dollars? Well, on a nominal basis, yes. At some point, the economy will blow up because free market economies require decision-making to be devolved to people. I mean, communist central planning doesn't work. And the more they run this story, the more economic power centralizes to a few people in New York, and the more you become like a communist country that can't function very well. But is there still room left to run that story? Well, probably.
Question I've received from a listener recently is in regards to fund manager Marin Katusa's advice for gold investors, gold stock investors, that is, to avoid all jurisdictions of countries that don't have swap lines set up with the U.S. Fed. And hopefully I don't do his theory disservice, but in essence, it's that countries that don't have these that don't have these swap lines set up, they're gonna experience a shortage of U.S. dollars, which is gonna make it hard to service U.S. dollar denominated debt. It's gonna cripple their economies, which will result in bankruptcies and also ultimately potentially the nationalization of the gold mines that are in those countries. What would be your response to such a theory?
Well, I think that's a very specific logical chain, and it's not impossible, but there are a lot of other possibilities too. I mean, there's no question that, again, as I mentioned earlier, the whole world is in debt in dollar terms, and so if you can't get dollars, then it's much harder to pay your debts back, or I should say, to maintain your debts. Right? You can never pay them back, but you can at least maintain them. And so the countries that, as you say, can't get dollars directly from the Fed have a hard time doing that. But there's another option, which is you just default in the dollar debt. I used to live in Argentina, and I always wondered why, when those IMF dollar debts come due, they didn't just say drop dead. We're just going to not pay back, hard default, and just go our own way with our own currency. And the reason they don't do it is because the politicians want to borrow more money in dollar terms, and so they don't. But to the extent that the dollar global hegemony is collapsing, there won't be that incentive to keep playing the game. And so I think you'll find more hard defaults. I also think that uncharacteristically, the developed world has much more debt than the emerging market world does. And so there's probably less economic damage that happens in some of those countries for a default than it would in the senior countries, to be sure. And then the last thing I would say is that I think the days of the tank rolling up and the colonel popping out and saying, "This is my mine now, get off," I think those are over, and for a few reasons. One is the way it works in some of the funnier jurisdictions in Africa is the government, quote unquote, gets a 10% carried interest, more or less. And really what that means is that the strong man takes 10% off the top and sticks it in his Swiss bank account. And it actually works pretty well because he gets paid off. The capitalists, Western capitalists, get their return on their capital. The employees get to work. The mine produces. And when he puts his friend in charge of it, as Mexico tried, as various African countries tried, Mexico with oil wells, everyone knows that the colonel can't run a mine, and so it shuts, and then that doesn't help anybody. And so that there is a nice equilibrium in these countries, some of them, where everyone's happy. And I'm not sure that a hard default of the country's currency changes that equilibrium. If anything, the cash flows of these things would go up a lot. And can I see them increasing taxes, saying, "Hey, we want 15%, not 10%"? Of course, but that's going to happen in the West too. I mean, in the 30s, the only thing that was producing cash flow were gold mines, so they raised the taxes on them, and that'll happen again. Now, it's a high-class problem to have in a depression because no one else is making any money at all, and so the stocks didn't really care much about that. But so, yeah, I mean, will some confiscate their mines? Well, yeah, I have no doubt. But will all of them? No, I don't think so. And I think that it's a good reason to have a broad portfolio of jurisdictions, because you don't know who's going to raise their taxes first and how they're going to react. And by having a broad dispersion of your capital, you can avoid getting overly harmed if one jurisdiction does something bad. It could be the U.S. I mean, who knows? I mean, the idea of private ownership is basically a thing of the past, so the government can do anything. And again, right now the gold space is much too small for anyone to care about. But to the extent that changes, you can have funny things happening. And I would just add one more thing, which is gold investors, the big bugaboo for gold investors is FDR, right? In 1933, he confiscated all the gold. And so you think, well, when is that going to happen again? If it happened in the U.S., it can happen again, and it can happen elsewhere. But if you think about it, when did he confiscate it? Well, first of all, he didn't confiscate it. He paid you $20 an ounce for it. Now, to be sure, it's worth more than that, and he shortly revalued to $35 an ounce. But at the moment he confiscated it, the stock market was down 90%, and the dividend yield was 10%, and that was under depressionary economics. And so you should have already sold your gold at that point and put it back into yielding assets. In other words, it was by the time the government moved to do that, you should be out of the trade anyway. And if you're so obtuse that you hadn't left the trade yet, he did you a huge favor by pushing you into the financial markets. And so I think some of these scenarios where governments are rolling the tax up, and if that happens, things are so bad and the prices of other assets are so low that you should already be out of the trade and into other things.
We'll be right back after this word from our sponsor. Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered, near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. When you look at the junior gold sector, where are you finding the best value right now?
Well, it's been tough because I'm sure, as your listeners know, it's really easy for fast money investors to buy the GDX or GXJ, the ETFs, right? And so they just performed tremendously well. They had this big spike low, and then all the money rushed in because it became obvious what was happening. Everyone wanted to be in the party. And so the stocks that have not been in the liquidity flow have not done as well. But again, this goes back to the distinction between value and liquidity. In my view, that in gold mining, this is one of the only sectors, if not the only broad sector, scale is your enemy. So the biggest companies do the worst overall. The barracks, it becomes such a management nightmare to manage all those mines and all those different jurisdictions, not just barracks, but all the big companies. And then on top of that, when you're a big company, you have to look for projects that make sense for your scale. And as we all know, as you scale up these gold projects, the pitfalls become enormous. The capex goes bananas. There are always overruns, and then they never perform as you want because they're so complex. Whereas you get some little company with a little deposit that you can actually understand, that can be financed fairly easily, that produces cash flow. It may have a better grades or whatever else. It might be too small for a major, but from a cash perspective, it may be better, and they're happy to tackle it. So I adamantly think that scale is your enemy. And right now, it doesn't matter because, again, liquidity is flowing to the biggest players, and it's opened up a divergence between the more senior guys who've really run and the junior guys they've gone up, but just not as much. And I think that the juniors will close that gap and overcome the seniors at some point. Whether it happens, going straight up or whether we go down first and they go down as much, that's harder to say. But I think there's a big value distinction at this point between the more senior guys and the junior guys, and then the junior guys have the advantage. It just takes time, right? Again, it's easy to buy the GXJ if you know what you're doing. To buy these juniors, you got to meet the management, you got to find the company, and meet the management, do due diligence, and get comfortable that you want to be part of the story. And then, again, the more capital you have, the riskier it is for you to take too much of a position. That now you lost your liquidity a bit, because if you buy 10% of a company on offer, you can't really sell it. So it just takes a lot longer for the capital to find it, regardless of the value. But to me, the value is there, and the capital will find it because capital is looking. Non-gold generalist capital is all of a sudden waking up and looking at the space, and that will take time. But they will find their way down to the smaller companies in the sector.
I definitely agree. Do you invest in the royalty companies also?
I don't, only because I'm looking I look for financial resilience at downside. So I've thought for a long time gold's going to $10,000 an ounce. I think the number's probably higher now, but that doesn't mean it can't go to 1,000 first. That was my view when gold was $1,800, whatever, 7 years ago. And so I don't just say, hey, who's the most levered guy? Who's the smallest grade to get that moonshot? Because if you're in those companies and gold goes against you for a couple of years, you're out of the game. And so I want some resilience financially so they can survive a dip, but then I want operational leverage, not financial leverage, but operational leverage. So when gold goes up, I get a big convexity on the upswing. So that's what I look for in these companies.
So like high cost producers then would be one of those plays.
High cost, as long as they don't have any debt coming due soon, right? Mm-hmm. High cost producer at $1,250 looks a lot different now. Gold is $1,700, right? So that's what I try to look for, or a developer, right, that doesn't have any debt and doesn't have any operations. And so if gold goes against you, it's really easy to furlough your guys and wait for better times and come back and when gold price recovers. And so I think that's key to survive this thing. If you look at, for example, a gold chart, I have a monthly gold series of gold price in Weimar marks. And from a distance, it's just a straight power curve. It just goes straight up. And you think, well, that's easy. You just buy gold and sit on it, right? But if you zoom into month-to-month changes, the volatility keeps increasing month to month as they get deeper in hyperinflation. So you might buy gold and lever yourself up enormously, saying, this is the easiest trade in the world. And then all of a sudden the next month is down 20%. Like, how did that happen? And meanwhile, your bratwurst is up like 10x. It's like, well, you're ruined. You get a margin call and you're out of the trade. And so you got to be careful about trades that are too obvious, because again, as the dollar does start spiraling down the toilet bowl, the volatility will increase. And so you've got to have positions that can maintain their ownership of the asset in the face of enormous volatility. But of course, you also want to maximize your performance. So it's a trade-off between operational leverage and financial resilience.
I'm going to put a link in the show notes, Dan, to your commentaries that you post on your website, Myrmikan.com. And can you, just before we sign off here, can you give listeners a little taste of what your articles that you write, your monthly research entails?
Yeah, so I try to give macro commentary once a month. It sometimes slips a bit if I'm too busy. But basically examining current events and how it's relates to credit bubbles. But my real expertise is I've been studying credit bubbles and historical. I'm actually writing a book on the history of credit bubbles. You can trace this stuff back thousands of years. There are 28 debt cancellations in Mesopotamia. I mean, that's how embedded this is in markets. And the first well-recorded one, which I discuss, is in Athens of 594 BC. So this stuff is nothing new. And so as we live through these events and there's this idea that these are unprecedented and this never happened before, and that's just wrong. This has happened before, not just once or twice, but dozens or hundreds of times. And so by looking at historic episodes, you can get a sense of where we are in our current cycle and what the future possibilities are. Again, I'm very confident that I know the end game, but the path to get there is very uncertain. And it does no good to be right on the end game if you screw up the way to get there. And so that's part of navigating this situation we're in. It doesn't have a happy ending.
You've been listening to Dan Oliver from Myrmikan.com. Dan, thanks for coming on the show today. I appreciate your insights.
Thanks for having me.